Hey everyone, Brad Palladini with Palladini Law, where we help people across the country solve tax problems with the IRS. And today we are talking about Form 433F and how to use that form to minimize the amount you have to repay to the IRS. So first we're going to talk about what the form is and who should be using it. Then we're going to talk about the difference between the Form 433F and other very similar forms that have a different purpose. Then we're going to go section by section on how to fill this thing out. And then last but not least, we'll kind of put it all together and talk about how to use the Form 433F in conjunction with the available options out there to repay your tax debt. All right, so what is the Form 433F? It is a collection information statement, a collection financial statement used by the IRS to determine how much you should be repaying them per month. It's going to have all of your income information, all of your expense information, all of your asset information, and the IRS agent reviewing it is going to look at it and see what is best for the IRS in terms of repayment. Now, there's a bunch of similar forms that serve a different purpose. So you have the Form 433A, the Form 433B, the Form 433A OIC, and the Form 433B OIC. So the B is for business, right? So if you have an S corporation, or you have a C corporation, or you have a partnership, you need to complete a Form 433B in order to pay the business tax debts back. The OIC stands for offer and compromise. So if you were trying to settle your debt for less than what's owed, you'd have to fill out either a Form 433A OIC or a Form 433B OIC, or in some cases, you'd have to do both. The Form 433A is essentially a long form version of Form 433F. Form 433F is like the short form version. It's not quite as detailed. So which should you be filling out? It really depends on who is handling your case with the IRS. So if your case is being handled by a revenue officer, that's a professional debt collector for the IRS, they're going to require a Form 433A because that's going to provide more detailed information than a Form 433F. If your case is with automated collections, which is basically your case is assigned to like a call center environment, you don't have one particular agent assigned to your case. You kind of call a general number and whoever picks up the phone is working it at that particular time. Then you'll want a 433F. In addition, it's going to depend on what type of resolution you're seeking. So depending on what type of installment agreement you're trying to go after, you might not even need to fill out a Form 433F. So if you qualify for something called the streamlined installment agreement, right? So you have a balance, it's $50,000 or less, and you're going to pay it off within 72 months. You probably don't even need to fill out any of these forms. You could just get on a streamlined installment agreement, avoid having to provide all of your financial information, and resolve your account that way. Okay, so now we're going to go through how to complete this Form 433F, assuming that's the form that you need to fill out. So at the top, it's just all of your sort of biographical information, right? So it's going to ask for your name, it's going to ask for your address, it's going to ask if you're married, it's going to ask if you have any dependents. The key to filling out the form is to fill it out as completely as possible. So that means if a particular section doesn't apply to you, just write NA in that particular section. That signals to whoever is reviewing the form that this particular section doesn't apply to you. If you simply leave it blank, then the person reviewing it doesn't know if you just forgot to fill out this section or if it doesn't apply to you. One of the keys in completing this form is making the IRS's job as easy as possible, right? You got to imagine these IRS agents are reviewing dozens, if not hundreds of these forms a day. They don't have much time to go through it. And so you want to make their jobs easiest so that way you get the best result possible. Next up is accounts, lines of credit, investment accounts. These would be things like a simple checking account, a savings account, a 401k, an IRA, stocks, bonds, things like that. The key here is filling it out accurately. One of the errors I see with people who try to do this themselves is they'll use all round numbers, right? So they'll have $500 in their checking account, $500 in their savings account, their Vanguard account is worth $1,000. An IRS agent reviewing that is going to know that it's a guesstimate, right? You didn't really take the time to complete this form accurately. You just kind of picked a number from the sky that you thought was pretty close to what was in there. So actually take the time to pull up your bank statements, pull up your investment accounts, pull up all of that information and write the exact number down. Don't make a guess. The other thing that's been new in recent years is virtual currency, right? So if you have Bitcoin or something like that, the IRS wants to know about it. The valuation is going to fluctuate very dramatically day to day. So you could just look it up whenever you're completing the form and just put the most accurate number you can at that particular time. Next on the form is real estate. So if you own a home, the IRS wants to know how much equity is in that home. The reason they want to know how much equity is in the home is because they want to see if it's worth either forcing you to sell the home or getting out a home equity line to make a lump sum payment towards them. One of the errors I see here is people exaggerating their home's worth, right? So for whatever reason, people always want to make their home sound more expensive than it is. So maybe it's an $800,000 home and they round up to $1 million. That's a bad idea, because the more equity that's in your home, the more likely the IRS is going to want you to either refinance it or sell it and repay them. You don't have to go out and get a formal appraisal for the house. You can go to things like Redfin and Zillow and Realtor.com and come up with an approximate valuation. You can take a low average, but don't go too low. The IRS has their own software that they use to look up your home's value. And if what you put down on the form and what they have is super far off, it's going to raise a red flag. Now, sometimes there's a justification for that. So we had a client recently who their basement was completely flooded and their septic tank was shot. So on Zillow or Redfin, it maybe said their home was worth $700,000, but they had to do $200,000 worth of repairs in order to actually make it worth $700,000. Because anyone who bought the home was going to have to sink $200,000 into it immediately in order to get it up and running. So sometimes there is a reason for a big deviation, and if there is, you want to, have that explanation ready. Next on the form is other assets. So this is going to include things like vehicles and boats and RVs and all that fun stuff. Again, you don't have to go out and get your car appraised, right? You can go on Kelley Blue Book or just go to a site that sells used cars and look up an approximate value. Generally speaking, the IRS isn't going to require you to sell your car, even if there's equity in it, because they know you have to get to work every day. The issue is if it's maybe a very nice car, like a Porsche or a Ferrari or something like that, and you own it outright. In that case, the IRS could say, hey, you could just sell this Porsche for $150,000, pay us, and then have plenty of money left over to buy a new, not as nice car. They're going to ask about credit card information as well. So it's going to ask for things like your minimum monthly payment. It's going to ask what your credit limit is for that particular card and how much credit is available. So if you have an Amex card with, let's say, a $50,000 limit and a $5,000 balance, the IRS could ask you to make a payment via the credit card. So that's something to be aware of when you're completing this form. It's also going to ask about business information. One of the things they're going to want to know about your business is if it has any accounts receivable. This is for two reasons. One, it could signal to the IRS that more money is coming in soon if you have a big AR, or if you're unable to resolve your case with the IRS, it is possible for them to actually levy your accounts receivable. So this is where they send a letter to your customers and say, hey, don't send a check to the business, send a check to us for anything you owe them because they owe money to the IRS and we should get paid first. Pretty crippling for a business when this happens. It just kind of makes you look bad to everybody you do business with. It also really hurts your cash flow forecast. You really want to follow this process through and make sure you're able to resolve your account with the IRS before it gets to that point. Next up is your employment information. So it's going to ask how often you're paid, and then you're going to take the information from a recent pay stub and kind of put that on there. Now the form doesn't ask for this explicitly, but you're going to want to do a little math to figure out what that means monthly. Now most people are paid every other week. Some people are paid monthly. Some people are paid weekly. It really just depends on how your employer set up payroll. So you want to go ahead and do the math and figure out, okay, if I'm paid $1,000 every 2 weeks, how much does that translate into monthly? And you're going to want to do the same thing for your deductions, right? So for your federal tax withholdings, your Social Security, your state tax withholdings, if there's health insurance deducted from your pay, you're going to want to do the math and figure out what the monthly amount, because we're going to need that later. Next up on the form 433F is non-wage income. So the IRS is asking about all your other income sources. So if you had a side hustle selling things on Etsy, that'll go down there. If you get alimony, that'll go down there. If you have a rental property where you get income, that'll go down there as well. You want to make sure all of your income sources are included. The IRS already has most of this information because they have your previously filed tax returns. They also have tax documents like a 1099 or a W-2 showing what other people say they paid you. So make sure all of the information is on there and it's completed as accurately as possible. Okay, last on this list is expenses. And this really is the most important part of the Form 433F. And you really need to know how the IRS reviews this particular section in order to get the best result possible for your situation. So you'll notice two columns on the Form 433F under the expense section. It's going to have what you're putting down as the taxpayer, and then it's going to have what the IRS allows. The IRS publishes various national and local standards for different expense items. The idea here is to have some uniformity as to what a reasonable expense is. So let's take a car payment as an example. They don't want somebody driving around a Porsche paying $2,500 a month trying to get on a $50 a month installment agreement so they can keep paying their Porsche, right? That's not really fair. So the idea here is to cap certain expenses so they're not extravagant. Now, the reality is most of these standards that the IRS provides is much lower than most people are paying. In particular, the housing and utility expense is quite low. If you look at the standards for like New Jersey or California, you would be hard pressed to find a home or a rental within what they say the maximum allowed is. Okay, so let's run through it kind of section by section. The first up is food, clothing, and miscellaneous. This is just a number that the IRS gives you. It's almost impossible to deviate from that amount. It's roughly around $800 per person. Now, in very, very special circumstances, you might get a deviation where you could put more than that, but you'd need, let's say, a doctor's note saying, hey, I'm on a very specific diet. I can only eat these very specific foods, and it costs more money than just eating regular food. But 99% of the time, you're going to be stuck with whatever the standard is. And that's going to be based on the number of people in the household. So if there's 4 people in the household, you're going to get credit for more than if there's 1 person in the household. Next up is transportation. So there's a couple different expenses here. One, you get a standard for public transportation. Again, most of the time, that's just going to be whatever the number the IRS gives you. They change these numbers pretty frequently. So whatever I say in the video could be updated by the time it's published or a year later. You could just Google IRS national standards and they'll kind of all pop up. But public transportation is somewhere around $205 a month. Then you have vehicle operating costs and vehicle ownership costs, right? So essentially this is your monthly payment for a lease or if you purchased a vehicle, and then also a separate expense item for things like insurance, gas, repairs. So for things like insurance, gas, repairs, you're pretty much stuck with the standard unless you have some super high insurance cost, right? So if your insurance is higher than what they're giving you, they'll allow a deviation up and above that. The vehicle cost for your monthly lease or your loan payment, you're generally stuck with the lesser of your actual payment or the standard, right? So let's say the standard right now is $500 a month and you pay $450 a month. They're only going to give you credit for $450 a month, even though that's below the standard. Now, what happens if you're above the standard? So let's say again, the standard is $500 a month, but your monthly lease payment is $600 a month. It's going to really depend on what type of installment agreement you're going for, whether they will allow the deviation from $500 a month to $600 a month. So next we're going to talk about housing and utilities. So housing and utilities consist of your rent payment, your mortgage payment if you own the home, your property taxes. It also includes things like your cell phone, your cable bill, your internet bill, and then electricity, if you have oil, your oil payment or your propane payment, trash, sewage, things of that nature. So here you are going to be limited to what the actual expense is or the local standard, and it's going to be the lesser of the two. So most people are going to be over the standard because the standards are fairly low. If you're under the standard, you want to review all of your housing and utility expenses and make sure that everything is included. So some of the mistakes I see is with expenses that aren't monthly, right? So let's take oil. Use oil to fill your house, and maybe you fill the tank 3 times per year, and it's $1,200 a time. So that's $3,600 for the year. That would be $300 for the month, right? But they forget about it because maybe it's summer and they're not really filling their oil tank. So go through it and make sure that in addition to these monthly expenses, you're also including the reoccurring expenses that happen less frequently, like once every few months or a couple times a year. Medical is another expense that the IRS will allow. So there's 2 different medical expenses. One is for health insurance. IRS will generally allow whatever your health insurance premium is per month, but they are going to want proof, right? So if you're paying $2,000 a month for your health insurance, you're going to need a receipt or some sort of proof that you actually pay that amount monthly. The other medical expense is out-of-pocket medical. So that's a standard amount per person in the household depending on age. Generally, you're going to be limited to that standard. However, let's say you have, expensive prescriptions. So you're paying $300 a month for some special medication. So long as you have the proof that this is a reoccurring expense monthly, they will allow it. Also on the form 433F, you have other expenses. And these are a bit tricky, but we'll go over a couple. So one is child and dependent care. So the IRS will only allow a child and dependent care expense, so like daycare for young kids, if both parents are working. So if one spouse is working and the other spouse is staying at home, they're not going to allow that child care expense. They're going to say it's unnecessary. But if both spouses are working, they will allow that expense because obviously you need somebody to watch your kids while both parents work. Student loans is another big one. The IRS will generally allow federally backed student loans, but you're going to need proof of payment. So they're not just going to take your word for it. You're going to have to send a few invoices showing that you're actually paying whatever amount it is monthly. Some other things that come up fairly frequently is private school expense. That's generally not going to be allowed. That is not an ordinary and reasonable expense in the eyes of the IRS, and so they're just going to disallow it. So earlier on, we talked about your income from your paycheck and your other income sources, and I told you to do a little bit of math to figure out how much your income is monthly. Now we have all of your monthly expenses, and the way the IRS is going to look at this is they're going to look at your monthly income on one side and your monthly expenses on the other, and they're going to want the difference between the two. And in most cases, you're going to be capped at the national and local standards. So we talked about the two different columns where it has what your actual expenses and the IRS allowed. You're going to want to run the math for both scenarios and say, okay, if they allow my actual expenses, what monthly payment am I looking at? And if they only go with IRS allowed, what is my monthly payment going to be? So overall, which are they going to allow? Are they going to allow your actual monthly expense, or are they going to allow only the standard? And it's really going to depend on the type of payment plan you're going for. So there's a few different types of payment plans. We're going to be posting videos on all these different types in the future. So take a moment now, subscribe, so that way you are alerted when we post those videos. But we'll go over them briefly to kind of wrap this up and pull it all together. If you're trying to get on what's called a partial pay installment agreement, so this means that you are going to pay them monthly, but the IRS will not collect the amount in full by the statute expiration date. So the IRS only has 10 years to collect from you. Let's say there's 5 years remaining, right? And you owe $100,000 and you're trying to get on a partial pay installment agreement for $50 a month. Well, the IRS obviously isn't going to get the full amount within those 5 years if you're only paying $50 a month. So this would be a partial pay installment agreement. If that's the case, you're going to be limited to the IRS national standards because the IRS isn't going to want to allow a deviation when they're not getting paid in full. In contrast, let's say you're getting on a payment plan where you are going to pay them in full, but it's going to take longer than the 6 years that they maybe usually allow. Maybe it'll take 8 years, and there's more than 8 years left on the statute. Since that's a full pay installment agreement, you have a better chance of getting a deviation from the IRS national and local standards. Last is currently non-collectible status, which isn't really a payment plan, but I like to explain it as a payment plan for $0 a month, right? So currently non-collectible status basically means this is my income, these are my expenses. I don't have any money left over at the end of the day to pay the IRS anything. And so they put you on a payment plan for $0 a month. So the IRS isn't getting paid anything. As you might expect, since the IRS isn't getting paid anything, they are less likely to allow any sort of deviation from the national and local standard, right? Because they're not getting money. They're not going to allow you to pay $800 for a car when a car payment should only be, let's say, $500 a month. Last but certainly not least, where do you send this? So you can complete the form 433F and you can mail it in. That is not our preference. We actually don't do it at our firm for a couple different reasons. One is it takes a really long time to get any sort of response, right? So you send this in and it could take 3 months, 6 months, maybe even longer to get any sort of response, and everything is kind of up in the air until you get a response. The other reason is the IRS does lose things, right? So at our firm, we mail everything in via certified mail, and still sometimes we'll say, we didn't get that document you sent. And we're like, well, we have the tracking number. We know you got it. Like, go find it, right? But that's just the reality. The other reason is sometimes you submit the Form 433F and they want additional information, right? So the IRS will review what's on the Form 433F, but also compare it with other information they have on file. For instance, let's say last year you had a part-time job working at Amazon for the season. And this year, when you prepared your Form 433F, you have no W-2 income from Amazon. That's going to raise a red flag. They're going to say, hey, you had this income source last year. This year you don't have it. What's going on? And so they might send a letter back to you saying, hey, send an explanation as to why you don't have, this Amazon income anymore. And that can lead to a lot of back and forth where you send the explanation as to why you don't have the Amazon income, and then they want 2 other things, and then you send it back to them, and this whole process now is taking like a year. So our preference is to call the IRS, call the automated collection line. It's a 1-800 number, and provide the information over the phone. Now, when we do it, we ask our clients to provide us with a lot of backup documentation. So that way, as we're speaking to the representative, if they say, hey, we want proof of this or we want proof of that, we can fax it over to that representative while we're on the phone. Again, we're just trying to avoid the back and forth. We're trying to get this resolved as quickly as possible for our clients. And so if we're using snail mail, these cases are just going to drag out longer than they really need to be. You can do the same thing. You can call the IRS. You can provide the information over the phone. There are free fax services out there, so you could sign up for a free account, have it loaded on your computer, and just be ready to fax them some documentation that they might want to put your request through. So that's how we do it. Hopefully this was helpful. We went over what the Form 433F was, the difference between that form and other very similar sounding forms. We went step by step on how to complete it, and then we told you where to submit it. If you have any other questions, leave them in the comments. More than happy to try and answer them.